Well, I just had the pleasure of attending Camp Kotok. This is the annual gathering in Grand Lake Stream, Maine. It's attended by major economists, researchers, investors. It's a great opportunity for us to talk mostly off the record about issues that are so timely and we really find ourselves talking about with our clients here at home. These issues include things like immigration, tariffs and inflation, the job market, Fed independence. There was a lot of ground that we covered. I can't share a lot of it because, like I said, it was off the record, but we did have some great conversations, and I'm so happy that I was able to attend. One of the things that we did talk about was the challenge for the Fed in today's environment. They are seeing noisy data. They are dealing with issues around data quality. We saw that with the most recent jobs report just over a week ago. They're also seeing some threats or challenges to their own independence from the Trump administration. So the Fed's job is certainly not easy in today's world. It's I don't think I've ever really envied the job of Chair Powell, but it is certainly not easy today. And it's not going to get any easier. This week we have the inflation report. We have the consumer price index and CPI coming out tomorrow, which is Tuesday. And what we've seen over the last several days since that jobs report is that expectations for the next rate cut have really moved up for their next meeting, which is in September. So now we're looking at about a 90% chance of a cut at the September meeting. Now, the interesting thing will be if this inflation report that comes out tomorrow, if it comes in hot, if it actually surprises to the upside and suggests that inflation is actually hotter than most people anticipated. If that happens, and we'll know soon enough, but if that happens, then this will make the lives a little bit more difficult for those voting members on the committee. As I said, that jobs report had increased the odds of a cut at the next meeting. But if inflation is proving more and more stubborn, that's going to make things very difficult. And it could cause them to think twice. So we'll see what that inflation report is. We'll see how the market responds. But I would say that is the issue that's most top of mind this week. That's the main event that we're watching. Now, as we look at market performance, one of the things we've talked about in recent weeks is the fact that the S&P 500 has really had a nice rebound following the April 8th lows. We're up about 28% or so off the lows. Really strong rebound. The question is, where do we go from here? It's hard at this point to see a major catalyst for that next move higher. We've seen quite an impressive run. We know that there is still tons of uncertainty, and so we remain neutral across our portfolios. We know that it's just very hard to make a short-term call, and so we try not to do it, but we do want to acknowledge some of the risks and some of the things that we're watching. A couple of those things are seasonality. Just the calendar is not our friend right now. We've actually seen that over the last 3 decades, the months of August and September are actually the worst for stock returns. Now, past performance is no guarantee, but it is something that we want to keep in mind. But I'd say if we were looking at some of the data, one of the interesting things that I'd point out is the fact that we're now about 90% of the way through this most recent quarter's earnings season. We've seen about 81% of companies in the S&P 500 outperform expectations for earnings over the most recent quarter. That is extremely high, and so that is certainly nice to see. But one of the things that many are talking about is the fact that the price movement in response to those earnings beat is actually well below what we've seen historically. And for those that actually underperformed expectations and missed on the earnings number, their stock is actually getting pummeled. They're getting hit quite a bit. And to me, what this is a sign of is it's a sign of potential investor fatigue. This is a market that where it's just very difficult to impress investors. If you're just beating earnings, that might not be enough right now. And so that is why, at least over the short term, I think it's really important to acknowledge how far we've come. And we don't want to assume that this is a trend that will continue. A little bit of a pause would not surprise us here. So I'll leave it there for now. If you have any questions, please don't hesitate to reach out to your financial advisor. I'll look forward to seeing you next week.